Hi everybody, thanks for joining us on this month's Market Compass video. So as we take a look back after a very strong 2021 that ultimately gave way to a very challenging 2022 where we saw both stock and bond markets decline pretty heavily, 2023 has so far been a more muted mixture of both of those conditions. And although stocks and bonds have logged gains so far this year, the list of challenges for the market has seemingly grown longer of late. In particular, the recent banking crisis, rising geopolitical tensions, and chatter of an approaching recession are starting to top that list of investor worries. We think each of those are credible uncertainties that shouldn't be dismissed. In particular, we think the most acute phase of the banking turmoil has passed, but the lingering effects will continue to show up in the form of tighter lending standards, which curb access to credit for both consumers and for businesses. This, in turn, is likely to add to the economic headwinds that are fueling those concerns about a recession. And while we think it will culminate in a mild economic slowdown this year, we do think that there are some opportunities for the economy to weather the storm. And then third, as geopolitical tensions continue to rise, we expect conflicts and emerging political alliances to spur bouts of market volatility ahead, as they've tended to do over history. Keep in mind, though, political and geopolitical risks have typically been short-term instigators of market swings, not long-term drivers of performance. So the road ahead in 2023 is hardly clear of potholes, but while headlines are likely to focus on the risks, we think current and upcoming conditions warrant a more positive outlook. So for this month, let's focus on 3 reasons for optimism. Reason number 1, we think the Fed is going to call it quits on rate hikes. Now, inflation, high inflation in fact, in 2022 was what led us to this stage of aggressive and sharp rate hikes from the Fed. And the good news is, while inflation is still too high for comfort, it is well off of its peak, and we expect it to continue to trend lower. We think the Fed may look to put one more quarter-point rate hike under its belt in its May meeting, but then we expect the Fed to move to the sidelines and hold rates steady for an extended period of time in 2023 as the central bank evaluates the impacts on inflation and economic activity. Now, let's be clear, this won't solve all the market's problems, but we do think that the end of monetary policy tightening or rate hikes is a very necessary condition for a new bull market to emerge. In fact, over the last 40 years, stocks and bonds, both on average, have logged gains following the last rate hike in a Fed hiking cycle. Reason number 2 for optimism. While recessions aren't good, this one won't come as a surprise. Now, what do I mean by that? So I recognize recessions and the talk of an upcoming recession doesn't exactly inspire a lot of confidence in investors. But here's the good news. Markets have been anticipating an economic downturn for some time. We do think we will see some form of a mild recession emerge in 2023. But again, here's some reason for optimism. The labor market, which tends to be the primary driver of consumer spending being the primary driver of the U.S. economy, the labor market's in rather healthy shape. And in fact, what we think is the healthy conditions of the labor market entering this downturn will actually help the economy weather the storm a little bit better. So we can look at the unemployment rate, which currently sits at nearly a 50-year low of 3.5%. We see job growth that's continuing. We see unemployment claims that remain cyclically low. All of this tells us that while the labor market is not going to be bulletproof through this downturn, we do think that the rather healthy starting point for the labor market will help consumers weather the storm a little better. Now, the economy then forms the foundation for corporate profits, and the good news here is that while we do think corporate profits are likely to decelerate as we move forward, companies have already anticipated some of this economic slowdown, which should help support a turnaround in corporate earnings in coming quarters. Now, we suspect this will probably be a source of market anxiety as we move forward and companies seek to navigate these uncertain waters. But broadly, we expect a rebound and a recovery in corporate profits to start to emerge later this year. That'll form a good foundation for market performance as we move forward over time. Markets are typically forward-looking. Again, this is good news. So while we might see the economic slowdown take shape as we move through this year, markets are going to start to look ahead to an ultimate recovery. Historically, the stock market has bottomed and begun its rebound well before recession comes to an end. Now, reason number 3 to be optimistic: bears don't live forever, and this one in particular is starting to mature. Now, what do I mean by that? Well, the current bear market, which started at the beginning of 2022, is now more than 15 months old. It puts it almost right at about the average length of a bear market downturn. And while bear markets don't have expiration dates, we do think that this one is moving into the latter stages. And the good news here is that typically when we reach this point in a bear market, average market returns looking ahead are quite positive. In fact, markets have averaged about a 16% return in the 1 year after the average bear market length, and better than a 25% return 2 years ahead. So what that tells investors is that even though we're likely to see some rough conditions ahead as we move through 2023, there's still a reason to be optimistic as we expect market recovery to take shape as we move through the rest of this year.
The potential for continued volatility ahead, it's natural if you're feeling a bit worried. During times of uncertainty, one of the things that helps me the most and that we often recommend to clients is to focus on the things within your control. When it comes to saving for retirement, or really any goal for that matter, 3 factors that directly influence your ability to achieve your goal are how much you save, how long you save, and how much your investments earn. The first 2 factors, how much you save and for how long, are largely within your control. And while you don't control what your investments earn, you do control your asset allocation, which determines your return potential. Having a strategy to achieve your goal is also within your control. Your strategy should define what you want to achieve and by when, estimate how much you need to reach your goal, and identify steps to help you get there. And while you can't predict how life will unfold, you can prepare for the possibilities by having an adequate emergency fund, maintaining adequate insurance coverage, and appropriately diversifying your investment portfolio. Having a strategy and working with a financial advisor can also help with another item that's within your control, and that is how you react to the inevitable ups and downs of the market. Your financial advisor can help you review and update your strategy as needed, run different scenarios to help you prepare for the what ifs, and navigate through the markets and life's potential ups and downs. So be sure to reach out to them.
Up next for the market will be the May Fed meeting on May 3rd, as well as the latest monthly reads on inflation and employment. So those important bedrock conditions for the economy that will help inform the markets as we move forward. The combination of each of these reports will be of particular influence to the markets as investors evaluate these trends through the lens of the outlook for the economy. We think investors should anticipate renewed market volatility as we head into the summer, particularly as rates remain elevated in the face of additional evidence showing a more sluggish economy. We do not, however, think stocks will have to give back all of the gains since the October low, and we'd recommend leaning into bouts of market weakness in anticipation of a more sustainable recovery that we believe will take shape as we progress through 2023 and into 2024.